Hi there, welcome back to AWM News Update. I'm Zoha Ahmed, and as usual, I'm joined by my co-presenter, Dariush Azani.
It's always great to be with you, Zoha. We have a great show today. ETFs saw particularly strong growth recently. Interest in ESG and sustainable investments continue to grow, and hedge funds saw some interesting developments.
Sounds great, Dariush. Why don't you get us started with a look at the markets?
Happy to. The ICI released Q3 numbers, and following the drop in assets seen from Q1 to Q2, fund assets rebounded, rising 1.3% to reach $53.99 trillion, up from $53.26 trillion. ICI noted, however, that the growth rate was somewhat diminished due to the US dollar appreciation in Q3. Overall, equity funds saw the strongest growth, rising from $22.1 trillion to $22.7 trillion. Bond funds saw minimal growth, only rising $4 billion over the quarter. Mixed assets saw similar growth, increasing by only $5 billion. Guaranteed funds assets actually saw a drop of $2 billion. In terms of market share, equity funds still account for the majority, around 45%, with bond funds following at 20% and mixed asset funds at 13%. While looking on a regional basis, the America accounts for the majority at 51%, Europe at 35%, and Africa and Asia Pacific at 14%. Finally, net sales were somewhat disappointing, only amounting to $178 billion. Equity and bond funds were on similar footing this quarter, with both experiencing net sales of $91 billion. Money market funds were the only funds to experience outflows, losing $53 billion at the end of the quarter. That's it for the numbers. Let's have a look at what's been making headlines around the globe.
A number of fund houses are doubling down on their ESG offerings. Fidelity, for example, launched its new Fidelity Fund Sustainable Water and Waste. This fund aims to seek sustainable investment opportunities in the water and waste management sectors.
Similarly, Amundi, HSBC, and State Street all launched socially responsible funds. Notably, Amundi launched another socially responsible ETF range this month, with 3 tracking the MSCI World, USA, and Europe SRI indices.
We've seen ESG and SRI themes become all the more prominent this year, Dariush. Japan's GPIF and other institutional investors are setting higher standards for their managers. Retail investors are calling for more accountability from the industry regarding these issues, and managers themselves have begun to walk their talk.
Absolutely, Zoa, and we are seeing more and more managers reporting on sustainability, not only on investments, but also on their operations. However, interestingly, when we get to the long-term performance, there are conflicting views. Larry Fink last year mentioned in the FT that the long-term performance of sustainable investment is at least equal to the traditional investments. Whereas if we look at the in-depth analysis made by Renaissance Capital, it just says the opposite.
Right, but I think it is important to emphasize that as these funds become more popular, that their performance is likely to increase.
That's quite possible, but we will need to wait and see. Turning to the UK, in a survey conducted by Schroders, 35% of the 400 financial advisors surveyed noted that their clients had either moved out of the UK in 2018 or were considering a move. This is a notable increase from the 21% in 2017. Uncertainty surrounding Brexit has certainly become a great concern for UK advisors and investors.
It definitely seems that way, Dariush. Almost 90% of advisors cited Brexit as the biggest worry affecting the clients in the coming year. It will be interesting to see how investor confidence changes as the Brexit date approaches. Let's turn to actives and see what's been making headlines there.
Active managed funds have struggled in recent months, experiencing major outflows. Morningstar dubbed this phenomenon Flowmageddon, with poor performance and high fees causing investors to reallocate their assets to passively managed funds.
This phenomenon reached new heights towards the end of the year in Europe, with European long-term funds experiencing the highest outflows since the height of the Eurozone crisis in 2011. According to Morningstar data, European domiciled funds suffered net outflows of $40 billion in October, and November and December seems to have been poor months for the funds overall.
Hopefully, managers have spent the bull run optimizing operations and preparing for the downturn. But that being said, there are signs of improvement in the active space. Fidelity's active funds saw inflows of $1.8 and $2.5 billion in September and October respectively, following 34 consecutive months of net redemptions. Now, let's look at passives and see what's happening in that side of the industry.
Sticking with Fidelity, they made waves this August with the launch of their zero-fee passive products. It seems that this has paid off, with these funds seeing $6.6 billion in inflows as of end of November, outselling their competitor Vanguard by over 40%.
Passive generally seems to have seen strong growth in the last year. Ignites performed a study of Morningstar ETF data, concluding that ETFs have grown 30 times faster than mutual funds over the last year. According to the analysis, ETFs grew at a rate of 9% between 31st of October 2017 and 31st October 2018, whereas mutual funds only saw a growth rate of 0.3%. This strong rise is likely due to the strong competition we have seen in the segment in recent years and the price slashing that has accompanied this. Stephen Libby joins us to discuss the strong rise of passives. Steve, looking at the rapid growth of ETFs, other than price slashing, what is contributing to this?
So the rise in ETFs is really about investors trying to get a much broader market exposure. It's also a lot of it in terms of the forces of requiring value for money. So with that, of course, the lower price passives in a bull market where it's tough for asset managers to, active asset managers to distinguish themselves, of course, gives that opportunity for the passive world to expand.
And Steve, passives have yet to face a true market correction. Offering little downside protection means that investors are likely to be badly hit should they not have diversified. Do you believe the passive industry will face strong outflows should this occur?
Well, I think that in general, when we're going to have a market downturn, I'm not so sure it's a question of active or passive. Both are likely, obviously, to be hit. Investors are going to look to make sure that they have proper diversification. So there will be a continued need for the passives. And the question is just, how will that shift perhaps occur to safer asset classes in general?
Thanks, Steve. Let's see what's been happening with alternatives this month.
Barclays Hedge recently released estimations showing that hedge fund redemptions reached their highest level in 7 years in September 2018. Globally, investors redeemed a total of $39.1 billion.
Up until September, hedge funds inflows totaled $2.7 billion, following strong net outflows of $9.1 billion in the third quarter. Last year's performance was somewhat lackluster compared to 2017, where inflows reached $94.8 billion by the same period. Hedge funds, however, saw improved performance last year as well, with global AWM reaching $3.24 trillion at the end of the third quarter.
Alternatives overall seem to be growing in popularity among investors. Mike Greenstein, PwC's global alternative leader, joins us now to discuss the growing attractiveness of alternatives. Mike, it's great to have you here. What are some of the factors driving alternatives growth in recent years?
Alternatives growth is really driven by two factors. One, returns, and second, growth. That's where the growth is. First, returns. From an investor's perspective, alternatives are where the alpha opportunities are. For a long time, alternatives have been an attractive way for investors to diversify and enhance returns. And with market conditions being the way they are, investors continue to look to alternatives as a great source of alpha. And many of those opportunities for alpha fall into what people are increasingly referring to as the private markets consisting of private equity, private debt, real assets, infrastructure, and natural resources. But the second driver is growth itself, growth in AUM and growth in margin. All managers are focused on growth, and alternatives is a great source of growth for the asset managers as well. Because while AUM is increasing, costs and revenues are also increasing, just at different rates. And so margin management becomes more and more critical. And that pressure on profitability is not just limited to alternatives. In fact, alternative fees have proved more resilient than fees in the other parts of the asset management industry. In our recent pressure on profitability paper, we predict that hedge funds and private equity fees will drop between now and 2025 to 116 and 155 basis points. But we also predict that the fees for traditional products, active and passive, will drop to, on average, 36 basis points. 36 basis points. So that means the fees for alternative products are 3 to 4 times that of traditional products. So that's where the growth is, and that's where the margin is. And it's no wonder that competition in alternatives is increasing, and we're seeing an increasingly segmented industry. And with increased competition and increased segmentation, the prize goes to both ends of the barbell. The big scaled up firms at one end that have brand, scale, and multi-asset class solutions, and the boutique, specialized firms, and the other that have a unique ability to source and tap into that alpha.
Thanks, Mike. Let's have a look at research reports.
November saw State Street Global Advisors releasing their annual growth readiness study, which takes the industry's perspective on what are the opportunities and challenges for achieving growth. The study found that investors' appetite for growth remains strong and that technology is likely to be the next big driver. Despite this, investment institutions are concerned about their ability to achieve their growth objectives.
Firms should be, Zoa. The industry has had a good period where they should have used the opportunities to strengthen their operating models.
The question is, of course, that how many have used this period to do so? While I'm sure many have, the market volatility and increased concerns of a coming crisis may put many to test.
Exactly. Well, November also saw the release of a Morgan Stanley report entitled "The Bear Has Begun." Morgan Stanley highlights in the report that the credit bear market, which likely began in February 2018, will continue in 2019 with high yields followed by underperforming loans.
Unfortunately, that's all the time we have left for this update. We'll see you next month. Thank you for watching.
Remember to like, subscribe, and share.